Hello, everyone. With me today is Saam Lowni, founder and CEO of Merryoaks and host of the Property People podcast. I've worked with Sam several times in the past, and mutual clients have spoken very highly of Sam and his team. So, welcome, Sam.
Thank you for having me, Tariq. How are you today?
Yes, good. Thank you. Good. So, Sam, I wanted to, if you could maybe start off with briefly speak about your background and what Merryoaks does, the type of clients that you guys work with, and the type of transactions that you work on. I think that'll be a good place to start for the audience.
Sure. So my background in property personally goes back to 2001, where I started out as an estate agent. Since then, I've become an investor, developer, landlord. I own properties in London, Kent, West Midlands, and the Northeast. Around 2017, 2018, I moved into finance. I was a founding member of a lending business. We did development finance, average ticket size around £10 million. And in 2021, I launched Merryoaks Property Finance, which is a finance brokerage where we support SME property investors, developers like myself, for all their funding requirements. Being a lender, I found that with the market being so fragmented, there's a lot of lenders out there. Navigating through it is a skill set in its own. And all the lenders are very specialist. Either they'll do bridging, or they'll do development, or they'll do term loan. And it's very restrictive, prohibitive. Whereas with my background, with my knowledge, I felt that I could be a lot more helpful to a lot more investors and developers and landlords, having used a lot of these products, having set them up from scratch, built credit departments. And to me, investors and developers across the UK, that's our audience, that's our customer base for Merryoaks, and we help them with all their funding requirements.
Oh, okay. So, looking at the first quarter, we're speaking in mid-April 2025 now. So, looking at the first quarter of 2025, can you maybe reflect on some of the notable transactions that you and your team have worked on?
Yeah, I mean, what's been really quiet has over the last 18 months prior to Q1 2025 has been development finance. That's been quite a tricky part of the market to navigate, with build costs rising, high inflation, high interest rates, elongated sales periods, rising build costs. It's just been really, really difficult for a lot of developers, and they've been caught out in some instances as well. So we've got a number of developers that I know that are really, really struggling to sell their sites to this day, and achieve the GDVs that they'd underwritten, 24, 36 months ago. So that's been really, really challenging. And over the last year, we were doing a lot of development exit, and that was helping developers just buy a little bit more time to be able to asset manage their sites and have call it a managed exit with the support of a lot of the lenders as well. In Q1 this year, I've found that actually the appetite for development is starting to return gradually. It's gradual. It's nothing kind of instantaneous where everybody's diving in head first. Everyone's being quite cautious. But there has been an uptick in those types of inquiries. There has been an uptick in appetite. Full-time property developers, that's what they need to do. They need to be able to find the next site. They need to be able to develop projects out and put food on the table effectively. So they've been a little bit more prudent in what types of assets that they are working on. A lot of developers as well are looking at sites for planning uplift. They're not necessarily buying sites with planning approval in place. They're trying to add value at the planning stage and then also at the construction stage. So getting in early, land without planning, ideally, and then the secondary is development finance, refurb finance, and finally the last one as well we are doing a lot of is commercial term loans, so high yielding income producing assets. The commercial term loans, those are becoming more and more popular, where people are looking at commercial properties and seeing how they can remodel them, repurpose them into usable assets. Everybody knows for such a long time that the town centres have been dilapidated. I think that there's now a price per square foot that you can find these assets at is so low that there must be something you can do with it, whether it be experiential or whether it be just a missing type of use that is not present currently on that high street. So those are, I think, the changes that I've seen in the first quarter.
And the point that you made about once the project's complete and developers are trying to then sell on the units, and there's, it's sticking, what like to call sort of sticking. It's just the market just not giving enough for it to shift quickly. Are there certain types of property that you're seeing sticking more, or is it like, what I've seen across some of my SME developer clients, it seems to be across the board?
So, I mean, yeah, there It's across the board, I must admit, and it's is it random? I don't. I mean, it's I'm seeing it all in different parts of the country. I'm seeing it with I've got a mixed use freehold whereby it's C3 residential with short let restriction, and just the type of income that it should be producing is not quite there yet. So that's knocked the GDV slightly because it's based on its income, and because rates are high as well, it just eats into your margin, and so the amount of money that that building makes is not as much as we'd like it to be. So that's sticking a little bit. I've got another guy with two houses to sell. That's not moving. That's two houses in kind of Great London where you think, wow, these are family homes. They should be flying off the shelf. And already he's had to reduce the asking price from what it was underwritten by a valuer 3 years ago, from 1.8 down to 1.5, and it's still not shifting. It's just not, it's not like, from my estate agency days, I know that as long as you're getting viewings, you'll get offers, but there's not even any interest from that point of view. And it's not, we've tried different agents. The bottom line is you say, well, you just have to keep reducing the price. And of course, somebody will buy it at some price, but developers are reluctant to reduce the price to the point where they're literally probably wiped out their equity already by now, but now they are already going to be taking a loss, and they've got PGs on the line, so they're going to be paying this site back. It's a really, really bitter pill to swallow. I've got another guy who's got seven flats in around London as well. Just these are perfect first time buyer, couples, rentals, professionals type stock for buy to let. And again, having to take a knock on the GDV. That one we probably will find a buyer for, but he's going to be making not a loss, but certainly, well, a loss. He's going to be losing some equity as well. It's difficult. I mean, it's a random, like you look across those three different things, and the only thing that's really working is the high yielding income producing stuff, because you can keep up with the repayments and you can ride it out to a rainy day, to a sunny day, ride out the rainy day, so to see a sunny day. So that's the only thing that I find that's really, really working.
So interesting because I'm actually for an SME developer, very similar numbers, and he's having to take a haircut of about 400K of the asking. And even then, the conveyancing is moving very, very slowly. You would think that, okay, you've already had a fairly healthy discount here. You would want to move things a lot more quickly and not be so pedantic, for example, with regard to snagging and stuff like that, right? But there's that 400K haircut plus also the snagging as well, which is just a kick in the teeth, and it makes it, very difficult. I think. And the same developer, we did a 14 unit scheme a couple of years ago, and those were flying off the shelf. So it's just 2-3 years difference, and it's having a very different impact. I think the market has certainly sort of moved, and I think like at least I think if you had, for example, like mixed use scheme, for example, let's say block of flats, you've got sort of a secondary exit there. You could potentially, sell some, let out some, refinance those onto, term mortgages and stuff like that. But if you've done a high end development where it's only going to be a sort of luxury home, let's say, or a high end home, not even luxury, but a high end home, you don't really want to be letting them out on a short term basis because then it just devalues the property as well. So it kind of limits your exit. So given all of those things, looking at the last quarter and transactions that you've worked on, are there any particular learnings or updates from those transactions that you think you'd like to share with the audience that they can then benefit as a learning going forward how to approach SME development?
Yeah, I mean, it's interesting you talk about that one. There was one site as well whereby the developer wanted to sell it, sales weren't flying in, needed to refinance, and actually he was thinking, if I rent these out, these are perfectly rentable units, I will get a bit of income in as well, and I'm gonna do it. I'm just gonna do it that way. And when he got it revalued, the new build premium he lost, so his LTV got knocked as well, and he was quite highly levered as well. So that, so if you are looking to, one of the learnings is if you are looking to refinance and hang on to something, make sure that you get it valued before it's rented out, because you will lose your new build premium. And if you're trying to get a 75% LTGDV development loan out and you're knocked 5% on the GDV because somebody's living in it already, suddenly the maximum leverage that you can get is usually 75%, and you probably need closer to 80% to get out of that situation. So that was a little bit disappointing from his point of view, and he had to put more cash in to save the deal. I think and that comes down to one of the biggest lessons that I've learned over the last firsthand at the very least. You always know the theory of it and people talk about it, but high leverage, especially when you're leveraging up debt, when you're going all the way to the maximum, and I've seen people do 100% LTC debt where they would build a stack with a senior lender on a first charge basis. They'll take a mezzanine piece, a second charge, and then their equity, they will borrow at 10%, let's say, thinking that that's a really good deal. And if you put it into a model compared to equity, where equity was, looking at target returns of 20-30%, you think, wow, this is going to be such a profitable deal for me, and I've put next to no money in, if any, and I'm going to be rich, and I can do this again and again and again because I can do an infinite amount of deals without putting any cash in. And building the capital stack in that way cripples you ultimately. If the market goes sideways, if the market goes down, ultimately you are going to be in a really, really sticky situation because there's no one that's going to be able to take you out entirely. And I have seen it in the past as well, and there's some developers that both you and I will know, some kind of prominent names in the marketplace that have crashed and burned in doing this, and effectively they become a unintentional Ponzi scheme. And we've seen it in the past when things are going well, when the market's going great guns and property prices are rising. It's a great strategy. The leverage boosts your returns and you come out looking like some sort of superhero, and you can go around telling everybody that I did a no money down deal and all that sort of stuff. And it really works well. Is the exception to the rule in terms of the marketplace thing. I think if you are going to be building a sustainable development business, investment business over the long term, you need to build the capital stack correctly. And that means probably taking on leverage at a maximum of 75% LTGDV, 90% LTC on the debt basis, and that's the absolute max. Really, you should be around 65% LTGDV and 85% LTC. You have 30% target return. Then if the market does go up and you have to give away 40-50% of that investor, they're going to come back the next time and do it again with you. And I think that's the big win in property development, is when you can do it long into the future, deal after deal. The best sign of a business is where you can do repeat business. So I think that high leverage thing is really important. And ultimately just knowing your stuff, persistence, perseverance, having the right vision, working with the right people, and giving everybody a fair deal, not scrimping and scraping on, trying to knock your solicitor's fees and trying to knock your surveyor's fees and trying to knock the contractors and everything. It can leave a bad taste in people's mouths. So it's a really difficult thing to navigate as property investment development these days compared to, I think, when I started in 2001 at the very least. There are huge risks, but there are also huge rewards. But I think if you have the right persistence, perseverance, and the right vision, surround yourself with the right people, I think those people are the ones that I've seen that have come through and have been adaptable along the way.
Absolutely, and I completely agree. I think clients who look at it as a marathon rather than a sprint are the ones I think who are going to have longevity and also ride out the storms. And I was speaking to someone else the other day, and they saying that the last few years we've had a lot of ups and downs. So we've had Brexit, we've had Liz Truss economics or lack thereof. So all, and then the election cycle and all the rest of it. I think now we just like to have a little bit of calm and
Stability.
let's have some stability, some boringness, so to speak, and just go with that and have a small sort of incremental increase. I think that will do all of us fine. Thank you very much.
As long as I know, across the pond, all this tariff war and stuff, I'm not sure where and how it will end. I think it'll be overall okay. I don't think there's going to be anything significant that we have to worry about. But certainly, it's never ending. It seems like since Brexit was announced, there always seems to be something that we're up against. And I mean, I think that's always been the way in any case. If you watch the news on a regular basis, it always seems to be the way. But I would absolutely welcome a little bit of boring, stability.
Absolutely. And Sam, have you sort of spotted any changes or updates in the lending market, especially in the first quarter of 2025 that you'd like to share?
Yeah, I mean, going back to the development thing, I think that's probably the biggest change that I've seen in appetite for lenders. They are both increasing their LTVs, LTGDVs. They're being a little bit more bullish, and their rates are coming down ever so slightly wherever possible. Of course, the Bank of England was over 5% until recently. Now it's at 4.5. Inflation was high. That's down back to close to the target of 2, at least hovering in that space. And because of all of that, development where we've got an affordable housing crisis in the country, and we've got to be solving for that by building more homes. And the Labour have committed to building 1.5 million homes in the next government period. The development lending has perked up, and they're willing to do a little bit more than they were over the last 18 to 24 months. They've been sitting on a lot of capital, so the liquidity is 100% there. And I think the other positive sign that I've found is the resurgence of the private high net worth individual that's willing to do that slightly quirkier deal. There are a bunch of lenders, for example, that they will do up to 65% or 70% LTV, but they are sometimes backed by high net worths that will give them that little bit of extra stretch on top. It'll be a blended facility. You'll only see one set of documents, but in the background, the way that the loan is built is typically some might come from a challenger bank. The lender themselves put in, as a principal, puts in a chunk of cash, and then they might have a high net worth investor that's willing to do like a special situations deal. And we've been able to put a few of those together recently, just stretching that a little bit further. And they were pretty shy over the last, again, 24 months. But they're starting to come out the woodwork all over again, and that's a positive sign, of course. And it's interesting. On one side, I'm saying don't take out high leverage loans, but I think there is a limit, and I think when the market is going in the right direction, and it seems to be hopefully turning a corner. I've been saying for a while, survive till 2025. I think before then, you just got to do whatever you can to keep your head above water. But now we're not quite out the woods 100%. But you can start looking to the future a little bit more optimistically. As much as the Labour government gets a lot of stick, left, right, and centre, especially from the property and the business community, they are doing what they said they're going to do, and that predictability of having high interest rates again creates that little bit of stability and that certainty that is what lenders and investors need to just get on with whatever opportunities they think are going to work over the next 12.
Yeah, absolutely. That's what I'd like to come on to as well. So what we're looking forward to in the second and maybe even the third quarter of 2025, certainly the I was about to say new Labour government, but they've been in power for about 10 months now, so it's not so new anymore. But certainly some of the policies, legislation coming out, like changes to the way planning is going to work, changes to legislation reform, and even with interest rates and lending and what have you. I think there's certainly the right soundings in terms of encouraging that 1.5 million new homes to be built. We have to sort of see that into actual reality. But from your perspective, what are you looking forward to in the second, maybe even third quarters of 2025?
Yeah, for this year, I think that the high yielding income producing assets are still going to be the most popular with us. We do a lot of that sort of thing. And whether we're talking about residential, so these are HMOs, these are service accommodation, a lot of social housing stuff is proving to be quite popular. Everything has its pros and cons, of course, and has its risks associated, but we're finding a lot of lenders that are adapting and adopting that sector. At first, they were very, very cautious about having vulnerable tenants in their properties. No lender wants the reputational risk of outing anyone that's vulnerable, whether they've got physical disabilities or mental illnesses and all that sort of thing. But that's starting to shift now, and I think there are a handful, a couple of handfuls maybe, of specialist lenders that are looking to operate in that part of the market, which from an investor and landlord's point of view, my portfolio is spread across the country, and I started out doing a lot of student stuff. That was my main focus. Then I moved it to professionals, and now I've moved it again into short lets. I do a lot of short let stuff, but because a lot of those markets are getting saturated, now I'm moving my stuff into social housing as well. I'm putting them on kind of 5-year leases, especially with interest rates and with the cost of living crisis and utility bills going up. The social housing high yield strategy seems to be really good in the residential market. Then you've got things like retail and commercial space. Very, very savvy, very sophisticated, experienced operators in those markets, looking at how they can take on buildings, whether they be mixed-use freeholds or out-of-town commercial assets, and repurposing them into things like co-working spaces and breaking up the units, almost doing like an HMO but for commercial and that sort of thing. So I think that type of development, if you like, is what we're seeing more of, and probably what I'm looking forward to helping a lot of people with.
I think certainly the Labour government has announced their interest to develop the care sector a lot more and identify that that there is clearly a bottleneck because we've got a fantastic National Health Service (NHS), but once patients leave the NHS, they need to go somewhere. And at the moment, there is a national care service, which is what they're trying to implement, they're trying to develop. And that the lack of thereof is causing a bit of a bottleneck for patients leaving the NHS, which in turn then puts more pressure on the NHS. So they're interested, I think, to develop that national care service. And certainly they've got the votes in Parliament to be able to pass that. So I think there's the opportunity there actually for a lot of developers, coupled with also planning reform in terms of grey belt. You mentioned about out of town areas. We know of we know a very well known planning consultant slash developer who's spoken very highly of grey belt developments or semi-industrial or ex-agriculture type units or land that could be repurposed towards uh, potentially even care, sport living type developments. I think there's a great opportunity there. So yeah, I completely agree. I think there's going to be some interesting things to look out for. So thank you very much, Sam. Really appreciate it coming on and sharing your thoughts over the last quarter and what to look out for. Thank you again.
Thanks, Tariq. Always a pleasure.